Welcome to this week's live ASX strategy session. Thanks for joining me. Great to have you with me for another year of strategy sessions, and great to be back to our live format after a couple of weeks of traveling. Plenty to go through today. Lots of movement in the stock market, some interesting things happening there, some really interesting things happening in the commodity markets, gold and silver and uranium in particular. And of course, any stock codes you're looking at, any stocks you're thinking about, get those stock codes ready. We'll go through those in the second half of the session. Okay, so everything today, general commentary only, doesn't take anyone's personal situation into account. Having been through all that, let's get straight into this week's first chart and kicking off with the ASX 200. And so the ASX 200, it hasn't been able to extend on its gains from the previous week. Is this something to be concerned about? I'll talk more about this in a moment. And then over in the US, the S&P 500 has had its first 2% down day for the year. Does that point to further weakness? I'll look at the frequency of 2% down days a little bit later. But before we get to that, let's start with this latest price action on the ASX 200. And well, after breaking higher and rallying off the moving averages last week, the ASX 200 has given back some of those gains. It's now back, well, has been back towards the moving averages. So the 50 and the 100-day moving averages are the two which I'm using on this chart. It's rebounded off there, but it is back around that moving average region. At this stage, I don't think this is a problem. The pullback, it's in similar proportion to the previous rallies and pullbacks that we've seen since the November low. So there's our low in November. I'll show you what I mean by using some Fibonacci retracements. It's a technical indicator which puts proportion to the pullbacks. It's an interesting one to look up if you're not familiar with it. So using the November low and going up to the first high point, you can see the market rallied, comes back into this green zone. That's the Fibonacci retracement zone. And then we had the next rally starting from mid-December, and then the pullback came, and again, it's come back into the Fibonacci region. Now look at the most recent run up to the high last week. And again, it's pretty much come back, touch below, but pretty much come back into that Fibonacci region. So we still have this. It's like a stepping pattern higher, which the market continues to do. Like we've seen on other occasions, we could get some more sideways price action over the next week or two. Like look at what happened earlier in the year, and then in late December, get these sideways price moves. Maybe we get something similar again along the moving averages around this fib zone. I think that's entirely possible, and that could then potentially result in a new platform along the moving averages that could allow prices to push higher. Maybe as we move into February. Let me just take those fib zones off. I think if the ASX 200 can continue to establish itself above the moving averages, then I think it keeps the odds in favour of the upside. And also note that the moving averages are also continuing to turn higher after turning lower down back in November. We're now seeing them starting to turn higher. The underlying structure here, it remains bullish, and I think we should continue to position our portfolios accordingly. What has been interesting has been that it's really been the two-speed nature of this market. And as I said, I think the underlying trend remains up, but the ASX 200, it's still trading. If you look at where it is now, it's still trading where it was in August. So look, come back over to August. This is kind of where prices are now. So really hasn't gone a great deal in the last 5 months. Yes, it's moved a bit around that point, but it's where it was about 5 months ago. So on the surface, it looks like it's been a fairly dull market. But that's not the case at all. In one corner, we've had the financials, and they've been struggling. So let's just get the financials. This is the ASX 200 financials index. It's been a pretty rough period for the financials. Price prices below these declining moving averages, and when prices below moving averages, it does add a layer of vulnerability to the structure. So it's not a great structure for the financials, and this has been weighing on the ASX 200. However, the weakness in the financials has been countered by the strength we've been seeing in the mining sector. So let me just quickly flick this over to the ASX 200 Materials Index. This is where the mining stocks all pretty much live, well, the big ones at least. And it's a very, very different picture when you look at this. And this is where much of the action has been over the last really going back to the April low. But particularly over the last few months, where the ASX 200 has been flat, it's really all been happening in the materials sector. And this is something we've talked a lot about over the last few months. I think this is a great example of one of the benefits of having an actively managed portfolio. And this is, I think, where we can use momentum to focus on what's working and then avoid what's not. So what's been working has been materials, has been mining. What's not has been financials. And we can use those momentum strategies to focus in on where the money flow is working at this point in time. So rather than just owning an index like the ASX 200, which hasn't done much since August, it's I think when we use these momentum strategies, it's a bit like cherry picking what appears to be the best opportunities at the time. And in this case, some of the best buys have been in stocks in the mining sector within this ASX 200 materials index. But I think there's a lot to be said. Look, that's not to say that you shouldn't invest in ASX 200 ETFs. Index investing, it can be a great longer term way to invest. I've got ASX 200 ETF exposure myself, but I think there's a lot to be said for using those momentum strategies to actively manage at least a portion of a portfolio and be exposed to what's moving at the moment, rather than being stuck in sectors which are just flat, like financials, which of course you end up in an ASX 200 ETF. And of course, that's what I'm doing with the Motion Trader Signals. It's looking for what's working at the moment. It's looking for the momentum. If you're not a Motion Trader member and would like to have a look at this sort of stuff, there's a link below for a free trial in the description section. Click that, come in, see what it's all about. There's one more chart I want to show you for the local market, and it is the equal weight, the ASX 200 equal weight. And I think this is a really important chart to take in. Look at what's happening now. So this is where you can see this latest bar. This is Friday at 1:10 in the afternoon, and we have the equal weight is hitting a new all-time high. Contrast this with what's going on in the ASX 200. Let's just quickly jump back over. There's the ASX 200. Still below its previous high. It's about 3% below its October high at the moment. Coming back over to the equal weight, it's at an all-time high. So it's a really interesting contrast. The reason I think this is an important chart is that it removes the distortion caused by a few of the big cap stocks, notably CBA, which is continuing to decline from its earlier highs from last year. And I think the equal weight, I think, gives a better picture of the top 200's underlying strength. There's no question, at least no question to me, that this remains a bullish trend. The moving averages are rising, prices above the moving averages, so again, the 50 and the 100-day moving averages. The index is hitting a new all-time high on an equal weighted basis. So none of these are bearish signals. I remain long stocks, and I'm continuing to look for opportunities. We're continuing to get signals through the Motion Trader scans. And as always, I've got my Motion Trader trailing stops to protect capital should the situation change. But at the moment, this is an uptrend. That's what we've got. Okay, so we're going to go over to the US market now. Then we've got the local small caps, the US small caps, the commodities, very interesting things there. All your stock codes, we'll get to them in a moment. Look, if you're getting some value from this, please click that like button and leave a comment. What do you think? What do you think about this divergence we have between the ASX 200 and the equal weight. Is the ASX 200 going to catch up? Tell me what you think in the comments. And but yeah, please click that like button while you're thinking about it. It really helps a lot, because then YouTube shows other people, and I can keep making these videos. So yeah, do that. Click that like button and leave a quick comment. All right, S&P 500 time. And well, you wouldn't know it by looking at this chart, but there's actually a lot going on in the US market. We're going to go through a few key areas in a moment. I'll show you what's going on beneath the surface. But first of all, the S&P 500 fell 2% on Tuesday. Closed about 2.1% below the previous day. And 2% down days, well, they're the stuff that headlines tend to be made of. And with headlines often comes fear and concern and all that emotional stuff. But is a 2% down day a sign of bad things to come? And the answer is, well, no, it's not. At least not on its own. It's just another day. A 2% down day. It's volatility potentially volatility within a trend, and we see 2% down days during most years. In fact, bullish years, bearish years. Well, we see more in bearish years, but even in bullish years, we get those 2% down days. So last year, for instance, strong year overall, but there were 2% down days. And then the year prior, and you look at 2024, looks like a particularly good year without any big sell-offs in between, yet there were still 2% down days. And then we can go back further to 2021, which was a standout year, and there were five 2% down days, as well as 41% down days. And this is in a year where the S&P 500 made 70 new all-time highs. And so these down days that cause concern and make headlines, really, I think the price for reward in the stock market is that you have to accept volatility and risk. It's like the two, that they go together. It's just how it is. So don't necessarily be put off by a 2% down day. Look at the underlying structure, put it into context rather than just seeing the headline. So what do I make of the S&P 500 now? Well, the underlying trend is up. And you can see that with the rising moving averages. The 50, the 100-day moving averages, they both continue to rise. Price is also above the moving averages. So it's a bullish structure, but it's lacking near-term momentum. And it really hasn't made any headway for about 3 months. So there's the late October high. Hasn't really gotten too far. It's been a touch above there, but it's pretty much still around its levels from the October high. If anything, it looks like the S&P 500 might continue trading sideways over maybe the next week or two or so. Possibly retest the low from earlier this week. It just doesn't have that momentum pushing it upwards at the moment. So when there's not momentum, then you look for, do we get more of that sideways consolidation? But just like the ASX 200, there's a lot happening below the surface. You just can't look at the S&P 500 and think, well, that's what's happening. Firstly, I'll show you what I mean. Firstly, let's look at the S&P 500 on an equal weighted basis. And well, it's on Thursday, it hit a new all-time high. And it continues to trend higher, as you can see by the moving averages and price being above the averages. So it tells a very different story to the S&P 500. While the S&P 500 is stuck around the levels from late October, so here's late October, the S&P 500 still stuck around late October. The S&P 500 on an equal weight basis has been trending higher and extended those gains. So this is a broad-based advance with increasing participation. And that's what you can tell by looking at the equal weight, because the equal weight takes more than one or two stocks to push it higher. Because it's equally weighted, you've got to get a majority of stocks rising to get that upward trend. Hence, I say it's a broadening in participation. And as we often discuss, strong participation is a sign of a healthy market. In the ASX 200, we discussed the two-speed market between financials and miners. In the S&P 500, it's tech and industrials that are largely countering one another. So, firstly, let's have a look at big tech. So, I'll use this ETF. It's the Magnificent Seven ETF. So, you'll know all about the Magnificent Seven, the big tech stocks. When you look at this group continues to pull back from its all-time high in October, and it's been consolidating ever since then. So the uptrend remains intact, but it's lost its near-term momentum, much like what we were talking about with the S&P 500. Doesn't have that near-term momentum. But when you look at this, it's not like it's in a downtrend, but it's in a consolidation phase. So this could either be like a couple of possibilities. This could be like a zigzag type move, which continues a bit lower, like breaks below the November low. That could continue to put pressure on the S&P 500, or maybe it's a coiling structure that just continues to move back and forth within a range before then maybe breaking to the top side. So all sorts of different ways it could go, but at this point, I think it appears to be a developing corrective structure after a strong trending phase, and that's normal. It's normal to get these corrective phases after strong trending periods, and because this group has such a large weighting in the S&P 500, it makes it difficult for the index to move higher when you've got the Mag 7 pulling back. But as you saw with the equal weight, sections of the market are rising. So let me show you one of the strongest sections, and we're going to do this through another ETF. This is an industrial sector ETF, and look what's happening in the industrials. You can also see this through looking at the Dow Jones. This is probably a broader population than just looking at the Dow. Industrials are rallying strongly after a 6-month consolidation. So look at this. So for about 6 months, 5-6 months, we had the industrials tracking sideways along into and then along the moving averages, and we've since had a breakout and a rally off the 50-day moving average. So quite a strong period for the industrials. And so this is bullish price action. It's not a sign of impending trouble for the overall market when you've got the industrials trading at all-time highs after a strong rally off the moving averages after a consolidation. I mentioned the increasing participation earlier. I want to quickly show you what's happening on that front. Let me just go down to an indicator which we look at. It's the Russell 3000. So this is a broad measure of US stocks, the Russell 3000, not 2000, which is small caps. It's the 3000, which is around 3,000 stocks, of course. It's a percentage of stocks above their 100-day moving average. And very interesting what's been going on here. We've been tracking this indicator for a while now, and it continues to show an increasing number of stocks above their 100-day moving average. So it's currently at 67%, and that's up from just above 50% at the start of the year. So this is a clear sign that participation is broadening. I think the play here is to stay long stocks, and I think it's a case of continuing to hold what's working and using a good exit strategy to sell what's not working. It's like run winners, cut losses. It's pretty simple, but yeah, it's probably not what a lot of people do. A lot of people tend to do the opposite. They run losses and cut winners. But I think that's the play here: letting winners run, cutting losses, cutting stocks that aren't working. Yes, there'll be volatility on the way up, and we'll almost certainly get more 2% down days this year. But this underlying trend in the S&P 500, it remains up. Okay, let's jump over to the small caps next. And I've also got I've got the US, you've got the Aussie small caps, got the commodities, gold, silver, copper, got oil in there, uranium, really interesting stuff happening there. And of course, your stock codes, get them ready. We'll look at your stocks and see what the technical structure is for those. But of course, that wraps up the free section. If you're not a strategy session, remember there's a link below. Click that, come in. Costs you very little, and we're going to go through a whole heap of stuff which I don't think you're going to see anywhere else. So yeah, think about doing that if you're not a strategy session member. All right, so let's go over and we'll start with the US small caps. So Russell 2000.